Hi, this is John Coumarianos with Mindful Advisory, bringing you a new edition of Driving Returns. We've got three items up this week. First, I wrote an article in Market Watch about target date 2020 funds. What are those funds? Target date funds are designed for you to invest in throughout your life. The date attached to the fund assumes the date you're going to retire. We chose the 2020 class of funds to examine to see if a hypothetical retiree in 2020 using one of these funds did okay using Bill Bengen's 4.7% distribution rule. It turns out we started with $200,000 and they did okay. If you use that rule, you have about $193,000 on average in those funds now after 4 years or at the end of 2023. Remember that rule, that distribution rule is take 4.7% your first year and adjust it in subsequent years for inflation. And the fear I had in doing this exercise was that inflation would have hurt the final balance of the funds because we've had almost 20% inflation over the last few years. Turns out it hasn't hurt that badly. Stock market has done quite well despite an 18% drop for the S&P 500 in 2022. The other question I try to examine in the article is whether more or less stock exposure is better during retirement. Clearly, over the last 4 years, despite the loss in 2022, more stock exposure has been better. The best performing fund was one of the T. Rowe Price funds that actually ended 2023 with a $200,000 roughly balance, roughly what you started with. So that's pretty good. The funds held up well overall. Second item up, REITs, real estate investment trusts. Boy, did they get expensive in 2021 or so. We're using a chart here of price to FFO. What is FFO? FFO means funds from operations. It's a real estate cash flow metric. The reason why you don't want to use earnings for real estate is because there's a big depreciation charge that's really unrealistic and doesn't uh, gives you a distorted view of what cash flow might be. So you want to back out depreciation. You want to adjust for property sales any real estate company has made to try to figure out what cash flow the existing properties are delivering to you as an investor. Turns out you're paying now 15, 16 times FFO, and that's not bad. That's about the average over the last 20 years. Much better, certainly, than it was in 2021 when you were paying 25 times cash flow. That was too expensive. Yield now on REITs. I don't think they're going to do amazingly well from here, but they may well beat the broad U.S. stock market for the next 10 years at their current valuation. The index has changed a lot in terms of the types of properties it owns. Cell towers and data centers dominate the index now. It's not just apartments and retail and office. In fact, office space, which everyone is afraid of, perhaps with some justification, is a very small part of the index now. So I think REITs are pretty good right now here at this price level. Last up is TIPS, Treasury Inflation Protected Securities. These are bonds issued by the U.S. government, the U.S. Treasury, backed by the full faith and credit, pretty credit safe if you believe the U.S. government is credit safe. They are yielding, the 10-year is yielding 2% on top of the inflation number. Sometimes I talk to clients and I tell them tips are yielding 2%, but they forget that that's 2% on top of inflation, which came in last month at 3.5%. So tips also strike me as a very good deal here. 2% plus 3% inflation, 3.5% inflation last month on an instrument guaranteed by the U.S. Treasury. That strikes me as quite good. Hold these and hold REITs as much as possible in tax advantaged accounts like IRAs and 401ks. They are not taxed well. Anyway, John Coumarianos for Mindful Advisory and for Driving Returns signing off this week. If you have questions about asset management or financial planning, don't hesitate to call us at 201 951 3509. Again, 201 951 3509, or visit us at mindfuladvisory.com. Thanks very much. Have a good weekend.